Papa Bear in a suit, Wall Street goals, teaching young cubs how to play the role. Market watch, stacking shutter. New with the knowledge, nobody does it better. Options, game tight calls and puts. Stocks flipping quicker than they flipping the goods. E-Trade dashboard, money to print.
All right, welcome everybody. My name is Noob Trader. This is Noobs. The purpose of this channel is going to be to bring you along on a journey where I teach my children how to trade the stock market. We have different ages of kids here. We're going to go around the table, introduce everybody, and none of them have experience in the stock market. When I was growing up, we didn't have the same access to markets that we currently do today. So there are a lot of parents out there that don't have the education to pass on to their kids to teach them about this kind of stuff. So that's kind of the purpose of this channel, is for both parents and youth alike that are interested in the markets. If you want to learn literally from knowing nothing about the market from the beginning all the way to being your own self-sustainable trainer or trader, we're going to do that here, and we're going to record it and offer it up for you, and hopefully you can get something out of it. So with that, we're going to go around the room. Eli, go ahead, introduce yourself.
My name is Elijah. I'm 10 years old.
You got to speak up, bud.
I'm 10 years old. I'm on a swim team. I play soccer and I like video games.
All right.
My name's Jaden. I'm 16, and I'm big into sports. I do soccer, swim, and track. And then I also lift a lot too.
I think you froze. You froze like this on the camera. Your camera froze while you were introducing yourself. It's okay. Aram, go.
I'm Abraham. I'm 17. I'm big into lifting, and I do swim.
You need to center yourself on your camera, dude. That's not even close, but all right, better. All right.
Just change the camera.
You might have to move your camera, but we'll hash out all that coming up. So with that, what we have set up here is everyone should be able to see. This is Eli's account. So we actually did a video yesterday. We had some audio issues. So he actually made his first 2 trades already during the video that we recorded yesterday. And this is the account that's being shown right here. This is being shown in software called Thinkorswim. This is a trading brokerage that is owned by Charles Schwab. And we will get it up and running here. So you have it up on your screen, correct, Eli? So you are controlling this right here. So let's just go do some familiarity with the software here. As you can see up on the top here, can you see my mouse right here? Right there. You can see the account balance. All the boys are starting off with an account of the same size. Over on the right hand side, Eli, where it says watch list, go ahead and click that watch list, because we created a watch list for you yesterday with just a few stocks. So scroll down on this list. There should be a watch list in there titled Eli's watch list right there. These are going to be, remember, these are the stocks that you chose to put on here. These first, scroll back up, those first 4 with a / in front of them indicate that this is a futures product. So these are market indexes. These are market indexes. So the very top one that says / MES, that's the S&P 500. The next one down / MNQ, that's the NASDAQ. The next one down is the Russell / M2K. And then the one below that is the Dow. Below that we have the volatility index. I put these on here and I go over them because these are, for me as a trader, these are my core general market health things that I have on any watch list. So anytime I look at the market, these are the first 4 things that I want to look at. First 5 things, excuse me. And then below, we just have a bunch of stocks that Eli was interested in, and then some other stocks that he actually traded. So below we have Roku, Apple, Tesla, Eli Lilly, Hood, and then further down we have Chewy, Palantir, Lyft, and Jumia. Some of those names may be familiar to some of you, and then others you might never have heard of. The cool thing about the market is you don't have to know everything about a company to make money trading that particular stock, depending on your trading style. Now, I want you to go ahead and show them the positions that you put on yesterday. So up in the top left-hand corner, bud, those three little arrows, click on that, and then go to Positions tab. I think you clicked Orders. Oh no, Positions. Okay, so yesterday, Eli placed a trade in Hood, and he placed a trade in Lift. And do you remember any of the stuff that we covered in the video that we tried to make yesterday?
I covered the spread.
You got to talk into the mic and you got to speak up.
I covered the spread, the amount of set between the bid and the ask.
Okay, yeah. So we covered option pricing and spreads. We also covered yesterday what a contract is, right? What an options contract is, what a derivative is.
Yeah.
So for the boys that were not in here yesterday, are you guys familiar with what a derivative is? And I'm going to take over this screen here, bud. My screen. For the boys that were not in here yesterday, I asked you a question. Do either of you guys know what a derivative is?
No.
A derivative is something that has no value in and of itself. So the reason that we use derivatives in the market in the form of things like a futures contract. So these, I'm going to go ahead and take over this and show my screen up here so I can have, where's BlueStacks? Okay, so back over here. All right, so these, can you see my mouse? These, can everyone see my mouse?
I can't see your screen.
You can't see my screen? Okay, up top there, you should have a drop down to show different screens. Your screen sharing. Well, maybe, I think your brother just had to figure that out. Show meeting, up at top, over, show meeting. There you go, got it? You see it now? Perfect. All right, so these over here on the right with the forward slashes, those are derivatives. That means they're a futures product. That means that they have no value in and of themselves. They get their value from an underlying asset. So the example that I gave to Eli when I explained this yesterday was, if I have a contract to buy a house, you have a house that's worth $100,000. I have a contract to buy this house for $100,000. Well, that contract's not really worth anything because you can go out on the open market and buy the house for $100,000. If you have a contract now that allows me to buy this house for a certain period of time into the future, say it's a 5-year contract, anytime in that 5 years, I can buy this house for $100,000. Well, what happens when 5 years passes and the house is still worth $100,000? That contract is worthless because you can go out to the open market and buy a $100,000 house for $100,000. So it's worthless at that time. But what happens if the house is worth $150,000? Say you paid $5,000 for that contract. Well, then that contract has value. But the contract itself is just a piece of paper. It gets its value from the underlying value of the house. And there are elements to the contract, right? The amount of time when it expires and what it gives you the right to do. Gives you the right to buy the house, or it could give you the right to sell the house. The person that sold you the contract, they would have the obligation to uphold their end of the contract, meaning they have to sell you that house, even though you have the right to buy it at 100,000 and now it's worth 150. They can't go out to the open market now and sell it for 150. They have to sell it to you because they wrote that contract with you. So that's what a derivative is. In and of itself, it has no value whatsoever, but it controls underlying assets that have value. And what we're going to be trading mostly are called option contracts. So if we go into, let me show you what an option chain looks like here. We'll just go into Eli's positions here that he opened yesterday. We'll go to the positions tab here, and right here you can see that we have an open position in Robinhood. Do you guys know what Robinhood is? No? Yes? What is Robinhood, Jaden?
Is it like pay trade stocks on it?
Yeah, it's a brokerage account, just like this, what we're using right here. It's a different brokerage account. It's designed to be a little bit more simplistic than this, but this is a little bit more powerful. So when we go into this particular position, you can go to this options here. Let me do it again. See this little 3 dots down here where it says more, go to show hood details. And that's going to bring you to, that's going to bring you to a chart of the stock itself, which the stock is up 1.66% today, trading at $24.33. On the overview gives you some information like market cap. It tells you the total value of this company as at the current price is 21.36 billion, and gives you more general information, how many shares have traded today, the opening price, the high of the day. It'll give the closing price, all that kind of stuff. But right here, options tab will bring up an options chain. And this will give you, see all these different expirations right here? Let me shrink that. Look at all these different expirations. They're different dates, and it'll even tell you how many days until that date is there. When we click on one, it'll expand and give you all of the different contracts. It'll show you in a list all of the different contracts. So right now, we're only showing 4 of them. You can select up to 4 legs right here, it says. I'm sorry, we're showing 10. We're showing 10 different strikes. But if you go up here to the strikes thing, you can adjust to see how many you want. I usually keep it to all, just because sometimes you'll want more than 10 strikes, especially on a larger price stock. So what we're seeing here, this strike thing right here in the center, what do we think that is? Any guesses on what the strike is? The strike is the price of the contract. So when you're agreeing to buy or sell something, you're agreeing to buy or sell it at a price. So the strike is the price. So I'm saying I want the $22 strike. And then you can come over here to the calls, or you can come over here to the puts. You see up here it says calls on this side and the puts on this side. And you can either buy or sell one of these contracts. If I click right here, that's going to be a buy. If I click right here, that's going to be a sell. Same thing on the other side. If I click right here, that's going to be a sell. And if I click over here, that's going to be a buy. All right. Now, what other elements are there that you see in here? Anybody? Abraham? Or what?
The ask and the bid.
Talk in your mic. Don't talk to me, bud.
The ask and the bid.
The bid and the ask. Yep. You guys see this right here? This bid and ask? Abraham, Jaden?
Yeah.
This bid and this ask. So if we look at this right here, you see how we file these calls down right here? This is what Eli was talking about. We covered some of this yesterday. This bid and this ask. What's the difference between these numbers? 0.03, so 3 cents. There's a 3 cents bid-ask spread. The spread is the difference between those two numbers. What's the significance of that? What does the bid mean and what does the ask mean? So the bid is what people, so if I'm going out there and I'm trying to buy this contract, right now the public price, the best public price that's being offered out there for this is $2. The best public price that someone that's going out there trying to sell it is the opposite. They're out there saying, I will sell it for 203, and then people on the other side of the market are saying, well, I'll buy it for 198. So somewhere in between there is where you're going to get filled if you go into that market and make an offer. Unless the market moves down or up, those people are probably not going to get filled at those prices unless someone really wants those contracts. Then they'll pay up to get in, or they'll pay down to get out, or basically take less to get out. So that's buyers and sellers, real time offering on both sides of the market, and that reflects itself in what's called the bid-ask spread, or the spread. The wider the spread, the more you stand to give up when you get in and out of trades, because you have to meet the buyer, and the seller and the buyer have to meet somewhere in the middle. And if there's a market that's moving in one direction and you're in a position and the direction's going against you, guess what? That other person on the other side of the market's not going to come to you to grab your order at that point. They know it's in their favor. So you're going to have to chase the market. And the wider that spread is, the more money you potentially lose getting out of a position, especially if the market's moving against you. What else is on here? This last over here, that just means this is what the last contract that was sold for, or bought, traded for. So these prices over here, just simply for this particular strike, the last one that was transacted was traded at that particular price. So what is a call contract? We have calls and puts. What are calls and puts? Abraham, any idea? So a call contract is a contract just like for the house that gives you the right. If you buy a call contract, you have the right to buy shares at a particular price at a particular point in the future. Now this strike that we're looking at right here is for 31 days from now, so August 16th. The way that these expirations work is there's monthly expirations and weekly expirations. You see right here, this July 19th, the very first one with 3 days left, that's the monthly expiration. Typically there's more liquidity, meaning tighter bid-ask spreads, more interest, more contracts overall being traded in the monthly expirations rather than the weekly expirations. You can still trade the weeklies depending on the stock, but you usually get more liquidity in the monthly expirations. Where was I going with that? All right, so the expiration of the contract. So depending on the time frame that you want, usually I am trading somewhere 30 to 45 days out in time. So if I'm opening a new position, I'm usually looking to trade somewhere between, 30 to 45, maybe 50 days, somewhere in that ballpark. That gives me time. And by doing that, there's other benefits to it as well. So the other element of the contract is obviously the price of the contract, right? What are you noticing here when we look at this screen as far as these prices? The prices are going down as the strikes do what? Get higher. You got to speak up. What do you notice about these prices?
Increasing.
They're increasing as
The strike increases.
the strike increases. Yeah. So why do you think that is? Remember what these contracts do. We already said a call contract gives you the right to buy it for a particular. So for the next month, I have the right to buy this at $25 if I buy this call contract right here. So why would the price go up if I want the right to buy it at $22?
Then you can buy it for cheaper.
Yeah, you're getting in at a lower price. If I have the right to buy it for 22, the likelihood of it being above 22 is higher than the likelihood of it being above 25, right? So if I want to go out here and buy the 30, the likelihood is even less, so it's even cheaper. And on the flip side, these contracts do the exact opposite of what the calls do. So this contract, if I go out and buy a put contract, it gives me the right to sell it. So if I want to be able to sell this at 25 in the future, it's going to cost me $255 or so. And if I want to sell it at 22, just like the call contracts, when you got out of the money. So you notice how these things are colored like this? You have these shaded area here and a shaded area here. Eli, you see this? You notice how this is colored here? It's shaded. Why do you think that is? Because on this side, if I want the right to buy something above this price, on this side, the put side, the stock price is lower than that, right? So the puts, we want it to go down. The stock price is already lower. So all of these are in the money. That means all of these are in the money. That means the stock price on the call side over here, this 24, it's already above 24. So if I want the right to buy it at a lower price than it currently is, or if I want the right to sell it at a higher price than it currently is, that means that contract is in the money. And all of these contracts are considered out of the money. So the money is where? The money is at where? Where is the money? If these contracts on the call side that are below the price are in the money, and the contracts that are above the price are in the money for the puts, where's the money? Abraham? Eli? Think about it. If I'm buying calls, and if I buy a call over here, the call strike price that I'm buying is less than the current price of the stock. That makes it in the money. If I buy a put that is more than the current price of the stock, it makes it in the money. So where's the money? It's gotta, you see this little line right here?
Yeah.
That's the current price of the stock. The money, whether the determining factor of whether it's in the money or out of the money, is where the current price of the stock is. So that's what's going to determine in the money or out of the money, your moneyness, as it were, whether or not you're in or out of the money, is the price of the stock. So once, if I buy a strike that's a 30 strike call, and it's currently, $5 away from the money or so, and the stock rallies all the way up to 31, then that contract would then be in the money because it passed the 30 strike. Same thing on the put side. If I buy a far out of the money, if I say I come out here and buy this 17 strike put for 15 cents and it falls all the way to 15 at the point where it passes through that 17, then you're in the money, and then you're making money at that point, which would be a good thing if you bought the put. So do you have questions on these contracts? Nobody has any questions? You understand completely? Huh? You got to have some questions. This is a hard concept to understand. So these contracts control 100 shares of any underlying stock. So you notice how they're displaying in things that say like in increments of like $2, $3, 70 cents. That doesn't actually mean that it's going to cost you $2 to get into this position, or $1 to get into this position. It's $2 times 100, because it's $2 per share times 100. That's just the way options work. It's kind of stupid. I don't see why they couldn't just put the regular price in there, but that's the way it works. So this $2 contract right here for the 25 strike is actually going to cost you $208 to buy that. And it's going to control 100 shares of stock. So say this rallies up to 30, you pay $205 for it, and it goes all the way up to 30 on expiration. Did you make money or lose money? If you have the right to buy it at 25 and you paid $205 for that right, on expiration, the stock expires at the price of 30 on the dot. Did you make or lose money? Okay, how much money did you make? Abraham, how much money did you make? Eli? Huh? You gotta sit up, bud.
I don't know.
Did you hear the question?
Yeah.
You're not looking at the screen.
So 25 to 30.
25 to 30.
that $5 increase.
That's $5 increase in the stock price, yes. You have the right to buy it at 25.
Put 200 in.
You put $205, you paid for that right.
So you made 1,000.
You have to pay $25 per share for something that's now worth 30.
So you can sell it 30.
You can sell it for 30. So if you have 100 shares of a stock at $25,
So you paid what? About 2,700 for it.
2,705 is going to be the cost, not the price. The price was for the contract was $205. It's real simple. When you're doing this math, you made $5 from 25 to 30 is $5 times 100. That's $500 minus what you paid for it. You paid $2.05 times 100 is
So you made about 300.
you made $295. You see how we got there though?
Yeah.
Are you sure?
Yeah.
Okay. On the 22 strike, let's say we bought this put. Remember, puts make money. When we buy a put, it makes money when things go down, right? So same thing, same exact scenario. You buy this 22 strike put for $105 is the last price on it. Now the stock expires at 20. On expiration, the stock is at 20. How much did you make or lose? Huh? We paid 105. It's close to 100. Do we make it or lose it? Are you paying attention, Eli?
Make it.
We made it. Why did we make it?
I was just guessing because you
Okay, well, why did we make it? If we bought the right to sell this stock at $22 a strike, right? So we have the right to sell it at 22. It's currently only worth 20, meaning I can go out to the open market right now, buy it for $20 a share, turn around, sell it because I have the right to sell it for what?
22.
22. So if I buy stock for $20 and sell it for 22, I made how much money?
$2.
You made $2 times 100 shares. You made $200.
Minus
But I paid how much for this right?
105.
105. So I made how much? $95. You tracking, Eli? Are you really tracking, or are you just saying you're tracking? Yes to which one? Huh? What's that?
Yes.
You are? You want to do the next one? All right, here's a test for you. I'm going to give you a relatively easy one. You see the screen here? Stock's currently trading around $24. You think that this stock is going to go ballistic and go crazy in the next few days. Say the next few weeks. So you buy the 30 strike call. Okay? The stock goes all the way up and stops right at 30. So in 30 days, it does rally. It goes and it goes and it goes. But it can't quite make it above 30. And it expires at 30. So did you make money or did you lose money? You have the right to buy it at 30 and it's currently worth 30. You paid $70 for the right.
Wouldn't you,
Buddy, you gotta talk into the
wouldn't you have the same amount of money?
you gotta talk into your mic. And you gotta speak up, please. What's the question?
Wouldn't you get the same amount of money if you buy 72 and it goes all the way up to what it's set for you?
Okay, I understand. You're saying because if it's worth 30 now and you have the right to buy it at 30 now, you didn't lose or make anything? What do you guys think?
That's wrong. You lost money.
You lost
because had to pay
70.
So you are on the right track. You didn't lose money or make money with the right to buy it or sell it in the sense that it moved too far or not enough, but you did put up an initial cost to buy the right to that contract. So the initial cost was $70 for that. And now the stock is current. You have the right to buy it at the same price that you can go out to the open market and buy it. So the contract doesn't have any value. In order for the contract to have any value, it would have to end. Please don't put your face on your mic. In order for the contract to have any value, it would have to go up to $30.01. And in that case, on expiration, your contract would have a value of what? 1 cent. So you would have not made $1 because you paid $70 for the contract or 70 cents, but you would have reduced the amount that you lost by that 1 cent. So in order for you to make a profit, you have to hit the strike that you choose on expiration plus the value of the contract. So if you pay 30 or 70 cents for this contract, your break-even point is $30.70. You have to be above that to make money. All right. Woo. So with that being said, I think we've kind of covered some basics of options. Let's go into your account, Abraham. Load up your account, and we will have you put on your first trade here. Let me get your account displayed on the screen here. All right, cool. We're back. So you can't see the screen? You should be able to. Click on Abe. You should. No, now you can see it. No, you can't. How come you can't see the screen? It's up at the top. Click on view. Oh, yeah, up at the top. You just had it. No, go back down. Hover down further. There you go. See it up there? Abe screen? To the right. There you go. Tracking? Tracking. Cool, cool, cool. So now, Abraham, you need to create a watch list. So go up to the watch list thing. That little, yep, hit that. Nope, the little drop down. And what'd you do? What'd you do? Okay, go. You can go to this little drop down where, see where it says this the watch list. Go to the watch list. Now the little drop down to the right of it. There you go. Now create new watch list. The blue thing. Then you're going to give your watch list a title. Type in little Abe or something because I think I already have one called Abe. Watch list. One word. Okay. Okay, so now you're going to add symbols to it. So the first 3 symbols that you're going to add are going to be, put volatility index in there first. It's /VX. V as in Victor. Okay, enter. Just hit enter. It should automatically add it. Does it? Did it? Hit OK. Hit OK with the watch list and see if that pulled in or if we actually have to. It did. Okay. So then go back into edit. All right. So now the next one that we're going to add is going to be /MES. These are the same ones and enter. Then the next one is going to be /MNQ. Then /R2K. Then /MYM. You're not typing anything, sir.
Is it
MYM. Yep. /. Those / just indicate to the computer that it is a futures product. And now we are done with that. So that's just basically general market health. Bada bing, bada boom. You're missing one there. You somehow got rid of the Russell. Go back into edit. Where did the Russell go? You must not have added the Russell. /M2K or R2K. I'm sorry. No, it's M2K. That's why it didn't populate. M2K. And then move M2K back up underneath the, yeah, right there. It's good. All right. So now you need to decide what kind of stocks that you want to trade. Do you have any particular stocks that you want to keep an eye on that you're interested in? Are there companies out there that you think are interesting? Company like Nvidia, company like Apple, companies like Microsoft. What types of companies out there are you interested in putting on your watch list? Nvidia, okay. So go back to your watch list. Nvidia is a huge company, one of the biggest companies in the world. Ticker for it is NVDA. Yep. Add it to it. Any other companies out there? Play a lot of video games. Do you have any video game software companies or video game companies that you want to track? BattleNet, I don't. It's probably owned by. It's probably owned by someone else.
Division.
Activision was recently bought by Microsoft, but I think they still trade. ATV. Activision. Activision. Yeah, ATVI. Activision Blizzard. Gotta hit the plus. Are they still an active ticker? All right, we'll worry about that later. Okay, what else? Are there any other? You like Monster Energy drinks, don't you? I mean, it's up to you what you put on your watch list. This is just so you can. Most people have Apple on there just because it's such a large product. Your Apples, your Googles,
Is it asshole?
Amazon's, AAPL. Yep, AAPL. Yep. Google's GOOG. And then you're going to have two that come on there. I trade the other one, but I guess you can trade that one. I trade the GOOGL.
What's the difference?
The type of stock share that it is the difference. What you can, it's fine. They're both very liquid. You can trade either one. And then Amazon, another huge company out there. Meta, Amazon, Meta, Google, Microsoft. This is all going to give you. Those are all big companies.
Remember we did like GE? That was one we did.
GE back in the day, they had a stock split, so their price is higher now. Go to GE, you can add it back in there because look at the price now. I want you to check this out. They did a reverse stock split. Go ahead and add it there. We'll go to that. When you traded it like years and years ago when you were a young kid, so go see, look at it now, 162. You traded it, it was like what, $6? Well, yeah, they had what's called a reverse stock split. So just like when a stock like Nvidia was trading at like $1,000 a share, $1,200 a share, or whatever. Once it gets to a certain price, they'll split the stock so it's more affordable and easier for people to trade, which is what Nvidia did now. If you look at the price now, it's around the 130 range. Where is it at? Nvidia 126.58 because they split the stock. So stocks that are doing the opposite, that are not good trading vehicles because of the size, because of the price of their stock has gotten too low and it continues to go down and down and down, they'll split their stock the other way, and that will increase the price of the stock. Or sometimes in order to stay listed on the market. So that Activision looks like it's not an active ticker anymore, so take that back off. They got bought out, so they got bought by Microsoft. I think you just have to delete it. Those sometimes companies are forced to split their stock if they want to remain listed on these marketplaces, because you can't have a stock trading for like a couple of cents and have very little value in order to remain listed by the rules on these marketplaces. Okay, so those are all great companies to keep an eye on for overall health of the market, but the prices on those stocks are a little bit in the higher end of the range. So in order for you to put a position on in a $100 stock, it's going to require more capital than you might want to put on in this particular account. But if you want to put on one larger position, you could do that. It's up to you. Or do you want to try and find some lower price stocks that you'd be able to get a little bit smaller positions on?
Maybe look for
All right, so now we're gonna find some smaller price stocks. So I like some of the ones. Are you adjusting your camera? Mic check, mic check. Um, I like some of the ones that Eli has on his. So Lyft is a lower price stock. So why don't we add Lyft on there? Lyft. You can put Uber on there if you want as well. It's a higher than Lyft, but it's still relatively lower priced. Uber. Add that on there. Add just the letter U. This is Unity Software. They make 3D technology for gaming companies. Unity does. Yeah, you are a little blurry. I wonder what happened. Yeah, why is your camera so blurry, dude? Maybe it just doesn't want to look at your face. Move your face instead of your hand.
What is this from?
Huh. Either way. All right, so Unity, let's get Palantir up there, PLTR. Okay, why don't you put on there, let me think of some other stocks. You add the same one that he had, that Jumia, GMIA. JMIA. JMIA. Okay. Yep. Okay, now let's put on there Intel, INTC. Okay. Put on there the Chinese car manufacturing company NIO, N-I-O. Do you want to put on there GameStop, GME? That's a liquid one. There's another Chinese company called Billy, B-I-L-I. And then DJT is Donald J. Trump's company, but this is a meme stock. DJT. What's that, bud?
Maybe McDonald's.
McDonald's, that's a $250 stock. It's not lower priced, but you can put it on your list for sure. Let me think of some other companies here. Rumble is currently trading. RUM is the, and there's a ton out there. So what you guys can do in your off time is go to a scanner like FinViz and just type in, stocks that trade over 10 million shares a day with a price under this amount, and that'll show you stocks that are typically liquid. And that's a good way to do it. But you have plenty on here for your watch list. So now go down to some of those lower price stocks and look at the different prices of them. All right. So another thing that I wonder if you can add, I don't know if you can add this right onto your watch list. I don't think it's an option in Thinkorswim. Let me see if it is. Here, implied volatility. Okay, you can't add implied volatility. So do this. In that little cog wheel, up at the top of your watch list, see the little cog wheel that's down to the left? This little cog wheel, up. Yeah, right there. Nope, down. The cog wheel. Yes. Sorry, I think I was looking at my mouse instead of yours. Click it. And then scroll down. Now in the search area there, type in IMP. See the implied volatility there? Go ahead and add that. Undo the, yep, add that up there. And then drag that up so we can see that on the first screen. We'll do it, we don't want it to be first. Scroll down, put it between the bid ask, hang on, whoa, put it this, yeah, right there. Okay, close out of that. Can we see that on the first screen now? Without having to scroll to the right. bid, ask. No, put it between the open and the, actually remove the open and put the bid or the implied volatility there. Put it where the open is and get the open out of there. Just move it down. You don't have to go. Okay, whatever. All right, cool. There. So now implied volatility. Scroll back to the bottom of your list with the cheaper stocks that you have there. Okay. So now you can see the implied volatility in these particular ones. So what are you noticing right away? There's some of these that are really high. You see Jumia here? That's 128 implied volatility. See GameStop? That's another huge implied volatility. And DJT, also really high implied volatility. Those are going to pay you more to take risk in them if you're selling options. Look at Rumble is also high. Billy's high. All of these are high. The only one that's relatively low is Intel. PLTR is even high, and so is Unity Software. Uber is relatively low. Lyft is high. So of those, you want to pick one that's probably, I would get rid of Intel off of your option. Don't remove it. I'm just saying, kind of for now, scratch that out of your head mentally. And then probably Uber, I would also mentally scratch that. But they're able to be traded. They're just not as high implied volatility as the rest of them. So find something on there that you might be interested in trading, and we'll go from there. Waiting on you, boss.
On Neo.
Neo? Okay, we can trade Neo. Go ahead. Click it. $4 stock. This stock has been rallying lately. You see, what's your time frame on that chart? You're looking at what? 10 days, 5 minute, or 1 day, 5 minute. Go ahead and click that. Adjust your chart so you can look out for the last year over Neo. Scroll down. First do 3 years, then we'll do year. No, go back. What'd you do? What did you do? Go down to time frame. Stop. What? Stop. What are you doing? They're already saved. Go down to time frame. Go back. Dude, what did you do? All right. They're already saved. You just click on them. You clicked on something different. Okay. So there you go. You can see Neo has done nothing but go down over the last 3 years. Okay. So now go back again to the, yep. Go to the, you changed your year to 5 years. So go back and put that to 1 year, 1 day. There you go. Now go back. No, the little up and back arrow on the top left. There you go. Don't double click. It's an emulator. Go back to the 1 year, 1 day. There you go. All right. So you can see over the last, since about June, we've started to bounce off this bottom, and then we've been consistently making higher highs and higher lows. June 15th there, right there. You see that where it says 615? Higher highs, higher lows going up. So I don't think this is a bad thing to trade. We can go into the options chain up top. You see where it says options? Go ahead. And then for something as low of a price as this, I would simply be, this is the 3-day expiration. Go out to the monthly that expires 32 days from now, or 31 days from now. August 16th there, 16th of August, down. 16th of August up. It says 31 days. There you go. Whoo, that was rough. All right. So now, stop. Stop. You don't use your wheel. Drag it like you would your finger on a phone, dude. It's an emulator. All right. So it's currently trading at 476. So this particular doesn't have a lot of juice in the 4 calls. They're practically worth not very much. Or 4 puts, I'm sorry. So if we're going to sell something in here, you would probably have to sell the 5s, or what you could do is buy the stock and sell a call against it. That's a covered call. So if you want to get long in this position, which I don't think it's a bad idea to get long in this, what you could do is buy the stock. So go up to this. Do you want to do that? Do you want to sell a put, or do you want to buy the stock and sell calls? Huh? They're basically about the same thing.
You could do you could buy it and sell it.
You want to buy the stock?
Mm-hmm.
Okay, so to buy the stock, go up to where it says buy up top there, click on the stock price. Click buy. Nope. Where it says buy. You were just there. Click that. It's going to bring up a window that says, I'm going to buy 100 shares of this stock. Now, you're buying 100 shares at $4.78 a share. So go ahead and hit review. Order confirmation. Okay, it's going to cost you $239 in buying power. Go ahead. That's because it's a margin account. Boom, order reviewed, order filled. Okay, so now you can choose to do one of two things. You can sell, well, you can choose to do one of three things. You could sell the 6-strike call, the 5-strike call, or the 4-strike call. The difference between those, now remember what we paid for this stock. We paid $4.78, right? So that means that if you sell the 5-strike call, you're guaranteeing someone that you'll sell it to them for $5, right? So you're going to make then from $4.78 to $5. How much is that? You're going to make $22 if you sell it for $5. It'll have to go up 22 cents to make it to $5. Plus, you're going to keep that premium of $33 or $34. So what's the potential that you could make if you sell that 6-strike call or the 5-strike call? You tracking, Jaden? Are you tracking? You are? If he paid okay, so if he paid $4.78 for this, what could he make if he sells, well, first of all, what does he make if he sells that stock in 30 days for $5 a share? Paid $4.78, sells it for $5. What does he make?
How many of them are is
100 shares. Everything we're going to do is in increments of 100 shares.
Sells it for 5, it would be
78 to what's the difference between 100 and 78?
30. 20. 22.
22, yes. 22. So you have the potential to make 22 plus the credit. What's the credit? What's the credit, bud? What was the last one traded for? You can see right on your screen. Remember the last option? Look at your screen. Last one, the 5-strike, last traded for how much? 35. So if we list it right now, it's currently 34 at 35. So they're somewhere in between there. So if you sell for 34, you make 22 on the appreciation of the value of the stock and 34 on the call contract, which equals what? 50 something. Yeah.
56.
$56. That's how much you stand to make if you get the shares called away. Would you like to do that, or would you rather give yourself another $100 of upside but only collect 11 cents in credit?
The first one.
The 5? Okay, so click that, sell. So you're going to have to click on the bid if you're going to be selling it. Click that. And then go up there and hit next. And then you're going to do one contract, because remember, one contract controls 100 shares. We already bought the 100 shares. Go ahead, review. You'll notice where it's going to say, this isn't going to cost you any money to do this. It's actually going to give, it says buying power effect is whatever the commission is. But really, you're taking in $34 in credit. So go ahead and hit send. Ding, and you were instantly filled. Bada bing, bada boom. Plus 8 more. What did it say? Plus 8 more. Filled Android. All right. So do you want to place another trade? That was a pretty small trade. You want to place one more just so you have something to look at? So go back to your watch list. Right hand corner, go back to your watch list. Right hand, the other side, bro. Dude. There you go. All the way down. Now, what are we thinking here? Seems like it's cutting off somewhat there. What are you looking at? What else looks interesting?
Rumble.
Rumble. Okay, go into Rumble. Look at the chart. This is also a pretty beat up stock. It's recently been rallying, but mostly on, I think, the Donald Trump news, just like DJT. Okay, go look at the chart. Look at the chart overview. Yep. Chart, that's a yearly chart. See where it's kind of spiked up here? Very, very much so in the last couple days. Okay, go back out to a 3-year chart. No, just click it. There you go. See, it was trading higher. It's been pretty weak. Pretty weak. Getting this spike may or may not continue to go higher. So if we go to the options chain now, go out to a month. Let's see what you can get on the downside. All right, I like that a little bit better. If I were you, I'd probably be looking at that 6 strike, and I would be looking to, instead of buying the stock, I would be looking to sell that 6 strike call or put. See how the last one traded for 35 cents? So click on that bid. No, that's the, yeah. And then what is that gonna, wait, before we do that, if we sell this, what does that mean? If you buy a put, it makes money when what happens? Stock goes up or down?
Down.
Down, because you're buying the right to sell it at that price. If you are guaranteeing someone else's right to sell it at that price. In order to guarantee that they can sell it at that price, you are guaranteeing that you will what? Buy it. So by selling this put, you're guaranteeing that you're going to buy 100 shares of this stock at the price of $6, and you're going to be compensated for taking on that risk at the $6 level. So go ahead and click next. Now, no. Look at the spread. Remember the spread? Go back. You can't see the spread in here. Go back. Look at the spread. How much is the spread between the bid and the ask? It's a wide spread. So you're going to try and get as close to that 40 as you can when you put this order in. So you want to mark that up to like 35. There you go. Put it in for that. So what does that put your break even at if you get filled at this price? Go ahead, submit it. So you didn't get filled in this one. Go ahead and just leave it sit there. The market might come to you, they might not. You might have to move it down to 30 later on. Or sometimes it's better just not to get filled. But what does that put your break even at? If you get filled at 35, you're buying the stock at $6 and you're collecting 35 cents. So what's your actual break even on that? What's your break even? Hey, Mr. Eli, you seem a little antsy over there. What's your break even if you're buying a stock at $6 and you're collecting 35 cents? What is your break even? When do you start to lose money? If the stock is above $6, you keep all 35 cents and you make $35, right? If the stock goes below $6, at what point do you start to lose money?
What, 565?
565. $6 minus the 35 cents. So if the stock stays above 565, you don't lose money if you get filled at 35 cents. Does that make sense? Okay. So I think we have covered. Did you have a question, Eli? You said wait. What's that? Okay. So all right, to recap for today, we covered a lot of stuff. Recap real quickly. Abe, list off 3 things that you learned.
Puts and calls.
Okay. Puts and calls are what?
So like,
No, but what are they?
I mean,
What's a put? What's a call? Like what?
Contract.
They're contracts, right? What kind of contracts? What kind of contracts are they?
contract to buy something at this price. So,
But what are they called? What is the name of a put and a call? They're called what? What kind of options? Yes, correct. And they're a form of a. Remember that word that nobody knew what it meant? Yeah, it starts with a D.
Derivative.
Derivative. They're derivatives, right? And what else is a derivative? We put derivatives on your watch list. Go back up.
There's like 5 stuff or 5 things.
Those 5. No. Just scroll up. The futures. Yes, futures are also a derivative because they have an expiration date and they get their value not from themselves, but they get their value from something else. All right. What did you learn?
I learned about like the spreads.
You're frozen. You're frozen solid. What'd you say? You learned about the spread.
The spread.
The spread. Okay. Is a wide spread good or a narrow spread good?
Narrow spread.
The narrower the spread, the better it is. Okay. What do you think causes the spread to be wide or narrow? So what causes it is the level of interest in that particular stock. So the more people that you have saying, I'll take it at this price, I'll take it at that price, I'll take it at this price, I want this, I want that. The narrower and the narrower, the more interest that you have in trading that particular thing, the narrower the spread. That's why it's better to have a narrow spread, because that means there's a lot of people interested in it, so it's easy to get in and out of. Okay. What else did you learn?
Just how to like kind of use.
Get familiar with the platform?
Yeah.
Okay. And so next time we will get your watch list set up and we will have you play some trades. So you both now have at least one trade on. Eli, you have your trades. So Eli, take the floor, show your screens, show us how your trades are doing. Do you remember how to do that? Before we leave, we'll do a quick recap. Share your screen. There's Eli's screen. So you are up $5, it looks like. You're up $5 so far. And look at this stock. You see Hood? See how one position is down pretty big and the other one is making money? So you see how the stock has moved up, which made your puts make money because you sold them. And your calls are losing money because you sold them. So as the stock goes up, the call starts to lose money and the put starts to make money.
You're controlling.
I'm controlling it? Oh, okay. And then the lift that you sold right here, this lift, it's just gone up and you just sold one put. So you just put a straight bullish position on and the stock price has gone up, so you're making money. Understand? Okay. Well, that's the first disjointed and a little bit crazy show. I hope everybody that tuned in enjoyed it. Thanks for hanging out with us for a little bit, and I am looking forward to doing this in the future.